Hi class, welcome to Chapter 9, Efficient Markets and Anomalies. Okay, objectives for this week: explain the efficient market hypothesis and the various forms it can take, relate the efficient market hypothesis to fundamental and technical analysis, understand potential for abnormal returns in special investment situations, explain how abnormal returns might occur in mergers, new public issues, exchange listings, stock repurchases, and other investment opportunities. Be familiar with the latest theories about the relationship of book value to market value, low PE ratios, and small size to superior market returns. Discuss the problems of distinguishing between superior returns and incorrect measurement of returns. Okay, so efficient market hypothesis. Oftentimes you'll see this referred to as EMH. Okay. Efficient market hypothesis simply states all securities are correctly priced at any point in time. It implies neither fundamental analysis nor technical analysis work. Okay, is that true? No. Okay. The market rapidly processes and prices all new information. I would say that's a yes in most markets. Okay. Requires a large number of profit maximizing participants. There's a yes there. Okay. Focused on analysis, valuation, and profitable trading securities. Okay, going down a few more. No stock price can be in disequilibrium or improperly priced for any extended period of time. Okay, information travels in a random, independent fashion, and prices are an unbiased reflection of all currently available information. So I would say that our market is mostly efficient. It's not perfectly efficient. It doesn't go by all these rules here, but it is mostly efficient. Okay. The efficient market can take three forms: the weak form, the semi-strong form, and the strong form. Okay? The weak form says that there's no relationship between past and future stock prices. Okay? Price of securities are presumed to be independent. Current prices reflect all available information, and information travels in a random fashion. Little or nothing to be gained from studying past stock prices. So when they say little or nothing to be gained from studying past stock prices, they're talking about using technical analysis, right? Technical analysis is very backward looking. So in weak form, technical analysis won't work. Give some tests here, the weak form analysis. I will let you do that reading in your book, but there's some tests they can perform to see whether something is a weak form, strong form, semi-strong form. Okay, serial correlation between stock prices over time. So basically this test right here that they're talking about for weak form is testing whether there's a correlation of price between yesterday's price or a year ago's price and today's price. Okay. Test based on frequency and extent of runs and stock price data. So we're, again, same thing as I described before. Okay. Another trading rule for the weak form is the trading rule test. Try to determine whether the given trading rules based on past price data, volume, and so forth can be used to beat naive buy and hold approach. So that would be along the lines of, does the stock always go up or go up 80% of the time when there's high volume, and does it go down 80% of the time when there's really low volume? You could use that information to try and make money. Okay. Implications for technical analysis. Any trading rule that relies on historical data and information will be of little value. As I said about 4 or 5 slides ago, technical analysis has no value in the weak form. Okay? Security prices do appear to be independent over time, or more specifically, move in a pattern of a random walk. Important keyword here, guys. If you don't know what that means, please do the reading and figure that out. Okay? Again, weak form, EMH, imply prices move independently, past trends cannot be predicted, technical analysis doesn't work, and no exceptional returns can be earned using anything based on historical data. Okay. Semistrong says that all public information is already priced into the stock, okay, including issued financial statements and public information about mergers and acquisitions. M&A is another short name for mergers and acquisitions. Okay. There's no lag in information. All the information hits immediately. Test of the EMH attempt to see if investors are acting on the basis of newly released public information are available to earn superior returns, adjusting for risk and transaction costs. So example of a semi-strong form EMH, assume a stock goes up 15% and the stock is 20% riskier than the market. Assume the overall market rises by 10%. On a risk-adjusted basis, okay, the stock would go up in the excess of 12%. Okay? Because 10% times 1.2, the risk factor, okay, to beat the market. Since the stock rose by more than 12%, it is said to have been beaten the market on a risk-adjusted basis. I won't quiz you on this formula. Test examining stock splits, stock dividends, and changes in accounting policy indicates that the market is generally efficient in the semi-strong sense. So, almost all the market impact of a stock split appears to occur before the announcement, public announcement. So, usually before they publicly announce a stock split or any kind of corporate action, there's rumors of it happening, right? And those rumors come from who? People who work inside the company, the market, analysts, whatever, right? The CEOs or other people in the company might drop hints about future action. So as the likelihood of future action increases, it becomes priced into the stock, okay? And they would do say that in some cases, our markets are semi-strong. Okay. Fundamental analysis cannot be used to determine whether a stock is undervalued or overvalued. Okay, do you think that's the case? Fundamental analysis, just like technical analysis, can work in some situations. So as we're seeing here, none of these market definitions perfectly match our EMH, efficient market hypothesis. Okay, strong form. Okay, stock prices fully reflect all information, public and non-public and otherwise. Right away, do you think that's the case? No, probably not. Okay, perfect markets exist where all information is available to everyone at the same time. No, that probably doesn't exist either. A lot of these are, theories, right? To help us, understand where we are in the market. Okay, strong form of EMH results in specialists on security exchanges have been able to earn superior rates of return on invested capital. Okay, corporate insiders consistently earn higher returns than would be expected in a perfect capital market. Okay, so that's cases against, strong form EMH. Okay, that we're not in one of those either. Special or abnormal returns, gains beyond what the market would normally provide after adjustment for risk, often referred to as anomalies. Transaction costs must be included when determining the existence of an anomaly. So, arbitrage is something would be considered an abnormal return. Okay, but sometimes you can, get into an arbitrage opportunity that seems profitable at first glance, but what can happen is, once you determine the cost of buying and selling that asset, it's no longer profitable. Mergers and acquisitions, premium for acquired company, right? So you often will pay a premium for the company you're buying based on its stock value. That's why, let's say, as the book gives an example, a stock is trading at 25. I want to buy that company and absorb it into mine. So I offer to buy it for $37.50 a share, right? I'm paying, a premium to get that share, okay? Sometimes you could be acquiring a form of payment, acquiring company performance. Maybe your growth is slowed, but this company's in high growth phase, but you have a lot of cash. Do you buy this high growth company? That can be beneficial. There can be synergies that occur there because high growth company might not have a lot of cash, but you're an old stable firm that might have a lot of cash but little growth. So you'll buy this, growth company, and you'll be able to provide it with the capital it needs to grow beyond maybe what it would have done on its own without your capital. Form payment is important too, right? Because you can pay in any one of these deals either cash or stock, right? Now there's different incentives for taking cash. So if you're buying my company, right, and I believe that when you buy it, it's not going to be as good, I'll want to take all cash payment from you. I won't want the stock, right? Because I believe that the stock will be overvalued. I don't think you guys are going to do as well with this new company as I did. Okay. However, if I believe that you buying my company was going to be this amazing thing for my organization, my former organization, I would say pay me in stock, because that way I can take advantage of the upside of the trade. Okay. So I guess right here it's going to go over a few things I just talked about. So merger price premium, the offer price over the per share over the market price per share. Again, exactly just the same as I used a minute ago, 1250, 3750 minus 25. Won't pay attention to this slide, it's in the book, you can read it if you like. Okay. Premiums for acquired company is a problem from an investment standpoint, does not support an efficient market. Why? Well, because if the market was efficient, the company would just have to pay the market price. Approximately 2/3 of price gain appears to benefit only the insiders, right? Because they already knew it was coming. They might have started buying shares already, okay? If the markets were perfectly efficient, insiders would not be able to benefit from this. Okay. There's some other issues here. Unfriendly takeover. Currently in the news, they're talking about a possible unfriendly takeover at Sirius Satellite Radio, where one of their big investors might want to buy the majority of the stock and then kick out management. That would be an unfriendly takeover. A white knight is something where somebody's trying to take over your company, but then a friendly organization will save you and keep management the way it is. So you'll have a hostile organization trying to buy you, and then you'll have a friendly organization pay a higher price for your company, and that will benefit generally management, right? But it's really hard to tell. Okay. Golden parachutes are for executives of the acquired company. So if the CEO gets kicked out because the company gets sold, guess what? The CEO gets a fat bonus as part of his deal. Like, hey, if I have to get fired because someone new takes over, I want to make sure I'm taken care of. And at that high up of usually the corporate ladder, they can demand those kinds of things. Although that's not always great for shareholders, right? But it could be good for shareholders because you are, in a sense, paying for a manager to care about the company. Acquiring company performance. Mid-Elker study indicated no abnormal gain for the acquiring company. Okay. Clash of management philosophies, fear price paid was too high. There can be synergies, though, if one organization buys another, and there could be, benefits. For example, if Walmart buys, which I'm sure they already have, shipping truck routes, so they don't have to use a third-party shipper for their products. They have their own trucks, they have their own warehouses. That could be something where, all right, we're buying a shipping company, but it's going to, drive down the cost for our shipping because we're only going to ship our own products. Okay. Again, this talks about what I mentioned a minute ago about taking a cash offer or stock offer. Depends how you feel about the deal, right? Also, there's a tax consideration. When you take the stock, you won't have to pay taxes until you sell that stock. But when you take the cash, you're going to have to pay taxes right away. It's another implication, right, that could affect your decision. Okay. An IPO, you should know what that is. When a company goes public by selling a formerly privately held shares to new investors. Obviously, everyone should know Facebook went public this year. If I didn't record a new video, this is 2012. IPO price may not fully reflect the true value. To avoid unwanted inventory, investment bankers may price the share price issue by 5 to 10%, underprice the issue, right? So they have a certain inventory of stock they agreed to sell. Generally when a company goes public, they don't put 100% of their stock on the market. They might put 5% on the market, right? And they might cut the price a little bit below its perceived value because it's good for them to, see the price go up in the morning when the stock IPOs. Okay. Also, a lot of times the company's looking to get a certain amount of money. They're selling 5% of the business on the market. They're looking for a certain amount of capital. They're not, they're not just going public for their health. Okay. Going public also, gives them a better idea of the value of their entire company. How do they get a better idea of the value of the entire company? That's because if they sell 5% of their company for, or let's say make the numbers easier, right? If they sell 10% of their company for $10 million, that must mean the whole company is worth $100 million. About, there could be some control premiums there as well, but more or less $100 million, all right? best time to buy an IPO is on the initial distribution, okay? So you don't want to buy Facebook stock, you know, at 9:30 the morning of the IPO. You want to be pre-allocated shares on the IPO before it goes public. And you have to have go through a brokerage firm, and you know, not any Joe Schmo can just go and do that. You have to be set up and organized and have a certain amount of money to be able to even get in on that initial distribution. Okay. Best time to sell is after the IPO, right? Immediately after, sometimes the stock pops. So if the shares IPO at $30 a share, but as soon as the market opens, they're up to 38. If you bought it, if you were pre-allocated at 30, sell right away for 38. That's almost a 25% profit. Okay. IPOs are not that good of an investment for the average investor, right? It's not a long. It's historically based on studies, it's not a good long-term play. Okay. Lower IPO price increases potential abnormal gain. All right, that makes sense. Okay. Moving down, investment banks want to purchase shares at the discount and issue at the premium. Right? So the investment banks will say, all right, we're going to price it at $30 a share. They have a pretty idea that it's going to go up, right? So they start selling shares of their own as well. Now there's different ways the investment bankers can sell the shares on the market, right? They can get a flat fee. They could get a certain percentage of the IPO. They almost act as, some kind of mortgage broker, and they're taking a percent of any money they raise. So they might say, all right, any money we raise through the IPO, we want 3%, whatever, or 1%. Exchange listings, that's just where you can list your stock. It could be the New York Stock Exchange, the NASDAQ, a number of global markets. Here's just some requirements for listing on the New York Stock Exchange. There's different requirements for each individual exchange, so those obviously have to be paid attention to. Okay. Stock repurchase, okay? Repurchased by a firm of its own shares. So the company is buying back its stock. It's like the reverse of an IPO, okay? Reasons for a repurchase: management believes the stock is undervalued. Management believes stock's going to go up. It can also be a sign that management is not creative. It could be a manipulative story, right? They want to raise the price of the stock. Simple economics, right? Decrease the supply, okay? If they have no more investment opportunities, they could buy their own stock back. It could be a negative or positive. So that's a good point, too, when we talk about investment analysis. A lot of these things that companies can do can be looked at positively or negatively, but you have to look at everything in this big mosaic theory to, get an idea of the long-term impact of any one of these decisions. Okay. Also, the stock repurchase almost acts as a dividend. Because it not in the true sense, but it acts, as I said, to decrease supply, so that's going to, in theory, all else being equal, raise prices. Here's another one right here, small firm and low PE ratio effect. They have superior risk-adjusted rates of return, investing in firms with small market caps. So this is just a theory, investment strategy. Roll suggests that small cap studies underestimate risk, infrequent and irregular trading patterns, transaction costs, and buy-sell spread. So, they're less liquid, and they are also less analyzed by the overall market. It's the equivalent of looking at, this is an extreme example, but like a penny stock, right? The penny stocks can be very volatile and move quickly. Okay. How to get superior returns. This is what the study says. Say its small size is a primary variable. Others argue that low PE ratio effect. So low price to earnings, meaning you're paying a very low price, right, for each piece of their earnings. Okay, makes sense. Found the French model. I won't go into that. Please read that in your book. It could be quizzed on. Okay. Same thing here. I want you to look at the calculations in the book. I probably will do a calculation on the quiz. Just some last things to wrap it up. The January effect says that because stockholders may sell off their losses in late December to establish tax losses, these stocks are often depressed in value in early January and may be a bargain opportunity for investors. Okay, the weekend effect Research evidence indicates that stocks tend to peak in value on Friday and generally decline on Monday. So this is kind of like a coin flipping, observation. It just tends to be that there's more up days on Fridays and more down days on Mondays. There is psychology, to the market, for sure. That goes without saying. The Value Line Investment Survey contains information of approximately 1,700 stocks using a valuation model. Each company is rated 1 through 5 for profitable market performance over the next 12 months. So it's a research-based value strategy. The surprise earnings effect, as indicated in the discussion of efficient markets, accounting information tends to be quickly impounded into the value of a stock. There appears to be little opportunity to garner superior returns from this data. But if you buy before a positive announcement of earnings, it makes sense, right? If the surprise is good on the positive side, you could, make money, okay? So it goes through each of these a little bit more. And I already talked about them all for you. Okay, truly superior returns or mismeasurement, okay? So, in our discussions in the previous chapter and in this chapter, we pointed out the possibility that returns may be the result of superior strategy in less efficient capital markets or an anomaly. It may also be the result of mismeasurement, thus showing that you got superior risk-adjusted return when you did not. You simply misspecified risk, aka beta component, or used the wrong model. If all risk-adjusted superior return studies were the result of misspecification, we could then once again assume that the market is perfectly efficient. The predominant view is that while there is some mismeasurement, many opportunities truly reflect market inefficiencies. These are special situations that, if properly analyzed, provide an opportunity for abnormally high risk-adjusted returns. Okay, so I did read that from the text. It is a little bit more of a complicated topic. So we're talking about high returns or superior investment strategy. Okay, now all this, when they talk about this in returns, they're comparing it to the market. Because it's all relative, right? If we have, a 20% return, is that good? A lot of you will initially say yes, because we're in a period of, really low interest rates right now, and that's what we've pretty much, most of us have grown up with for the last 20 years. But there was a time where you could earn 12 or 13% in your bank account. The interest rate was higher. So, again, 20% return when you can get 13% or 12% in your bank account isn't such a good return, right? It's all relative to the market and your whole universe of stocks. That's it for this week, guys. I will be posting this video now, and if, as usual, if you have any questions, feel free to reach out to me.